Our final call, Spruce Point warning of a 40 to 60% downside risk on Zillow, the online real estate company, warning that the core business has matured and new growth is facing near and long-term headwinds. Ben Axler is out with the new reports. He's the Spruce Point founder CIO. He joins us now. Ben, it is good to see you. So you're betting against Zillow here. Ben, you see shares could fall maybe 40, even 60%. How come, Ben? Walk us through the argument and why make this bet now, Ben?
So we love companies like Zillow. This is not a news story. This is a very mature tech company that's under fundamental pressures and regulatory and litigation risks. So let me explain. Fundamentally, there's a new entrant that has committed $1 billion to market against Zillow, and that's Homes.com, which is owned by CoStar, a company 3 times the size. They rolled out a bunch of Super Bowl ads you may have seen. That's not a company you want to bet against. Secondly, what we think people fail to understand is that Zillow's core customers are buy-side real estate agents. So they sell leads to these agents. Now, there was a landmark lawsuit against the National Association of Realtors that lost a lawsuit, which effectively, we believe, is going to unbundle broker commissions between buyer brokers and seller brokers. What that means in practical terms is that ultimately we expect a lot of brokers to leave the industry, commissions to compress, and that the budgets and money available for Zillow's core customers to spend on Zillow is going to go down. So, we have these overarching issues against a company that has failed to hit its targets time and time again, that's overvalued, that has poor governance, and ultimately we think 40 to 60% downside risk.
Ben, I am curious, Josh asked about the timing here, and, the litigation stuff happened late last year. Homes.com has been deploying capital, and the stock went down quite a lot. So the bulls might argue, well, a lot of that negative news is priced into the shares here.
So let's tell you what's new. Zillow just put out their year-end earnings and updated their investor presentation, which they hadn't done in 2 years. And if you look carefully, they retracted their 2025 revenue goals. And by that, they implicitly guided down substantially their 2024 revenues. In addition, Zillow has been telling investors that they're going to get the 45% EBITDA margins. They also said that was by 2025. If you look carefully, they no longer have a time frame, but yet are still sticking to this 45% EBITDA margin target. And what's odd here is that if you look at the market estimates, the analysts, the majority that say buy, they're not even forecasting 25% EBITDA margin. So there's a huge disconnect here that seemingly the analysts don't even trust management's guidance, but yet the stock seemingly has upside to $60 per share. So the timing, if you ask us, is we look at a stock that most recently was trading $57 to $58 a share with very limited upside and a lot of downside if our litigation thesis plays out and our competition thesis plays out.
Ben, I'm just curious, how much of your call here, if at all, is related just to the broader health of the housing market, Ben? Meaning, if the housing market was on stronger footing, would you still be making this call on Zillow?
I think there's a misperception. Zillow isn't as much levered to housing as you may think. So they have this mechanism where they sell leads under a market-based pricing. A lot of the high-quality zip codes that brokers might buy are generally saturated or sold out, and they don't have a lot of pricing levers there. In addition, they've also switched their model a little bit. So they're rolling out this, what they call flex model. And what that means is Zillow will give leads to brokers, okay, and book revenue on that. And then years later, these leads may convert and that broker may close a deal and then pay a commission to Zillow. And this creates some friction between some of their clients that aren't under this model, under this flex model and the other model. So there's some friction there. And there's also a lot of unknowns. Zillow won't even tell you the frequency or the conversion rate of these leads. So we don't think Zillow is necessarily as levered to the housing market as most people think. And as such, that's why you haven't seen the leverage in the margins and also why they've had multiple disasters in the past. I'll just recall they destroyed over $8 billion of value with their iBuying program, which was supposed to use their knowledge and intelligence to buy and sell homes, at a better pricing mechanism than the general market. That failed too. So we really don't think Zillow is levered to housing to the way the market believes it is.
That would have been a good time to short the stock too, perhaps, Ben. And lastly, I'm on that front. I'm just curious what your financial interest is here. Are you in fact short the stock, or is this just sort of a research report that's out there? And what do you have to gain as the stock goes down?
100% fully disclosed, and that's the front page of our disclaimer. We are short the stock. We made our best efforts to do as much high quality, differentiated forensic research as we can. We laid out the facts to the best of our knowledge. Management isn't commenting. We certainly have an open invitation to them to call us and correct us where we're wrong or issue a rebuttal, but we certainly haven't seen that at this point.
We should mention we did reach out to Zillow for comment, but have not heard back. Regardless, Ben, thank you so much for joining the show today. Appreciate it.
Thank you very much for having me.